Hi everyone. It has been a hard 3 weeks for many traders and investors. If you have lost a lot of money and your portfolio is down significantly, perhaps it's a good idea for you to listen to the very end as it will help you tremendously. As Trump continues to impose tariffs on Canada and Mexico and other countries, the market begins to get worried on how much this trade war will affect markets. Will the sell off continue or will we see a bottom soon? In this video and analysis, we will seek to look at the facts before us and also what the S&P 500 is telling us through technical analysis. After all the sell-off, will the stock market be positive this year or will it be negative by the end of the year? Historically, the S&P 500 has slanted towards positive returns. It has a 69% chance of being positive in any given year, a 79% chance of being positive over a period of 5 years, an 88% chance of being positive over a period of 10 years, and 100% positive return over any period of 20 years. So, with this in mind, one should treat the sell off with perhaps a more positive attitude. Recently, the S&P 500 has slid to correction territory for the first time since 2023. And for those who are new to investing in the stock market, this will be the first time that you are experiencing something so significant, painful, or worrying. It may be terrifying, but for those who have gone through the markets for the past 20 years or more, it is probably just a small bump on the road for you. Having said that, let's take a look at how often the stock market declines by 5%, 10%, and 20% or more. A 5% pullback happens quite often, which can be 3 to 4 times a year. It typically lasts for a few weeks and are great buying the dips opportunities. A 10% or more decline, which is considered a correction in the stock market, typically happens about once every 1 to 2 years. It often takes a few months to recover and can happen due to economic concerns like tariffs now, geopolitical events, and Federal Reserve's policies. A 20% or more decline, which is considered a bear market, happens once every 6 years. A bear market lasts about 14 months on average, but sometimes can last for a shorter period of time, like the COVID bear market, which took only 5 months to recover. Now, this is an article from Fidelity, which states that from 1980 to 2024, only 3 years didn't suffer a decline of 5% or more in the S&P 500, while about half the years saw a decline of 10% or more, which means that a 10% decline is quite normal actually in the stock market and not something to worry too much about. But the question for us now is, which category are we probably in right now? Is it a 5% pullback, the 10% correction, or are we going to the 20% bear market? Well, definitely we are past the 5% pullback and now we are at the 10% correction territory. So will we go past the 20% into bear market? That is the question, and that is what we will seek to answer. Now, if you have found the content helpful and insightful so far, do give me a like. And if you want to view more content like this in the future, do subscribe to my channel. It only takes a second to click on the subscribe button. Thank you very much. Let's move on to the technical side of the stock market by taking a look at the weekly chart of the SPY. The SPY is the ETF or exchange traded fund that tracks the S&P 500, and it does a pretty good job of doing that, and it is one of the favorite ETFs of many traders who trade the S&P 500. Here's a fun fact. SPY was previously the largest ETF in the world with an asset under management of about 600 billion, but now it has been overtaken by VU, which is the Vanguard S&P 500 ETF, which has an asset under management of about $632 billion. As mentioned, this is the weekly chart of SPY, and let's start with two things that give us the bear case, and then we'll move on to the bullish case. First of all, something that I do not like is the fact that SPY has broken below its long-term uptrend line. Trendline breaks can often be an early warning of a change in trend. Therefore, it is something that traders and investors should pay attention to. Secondly, SPY formed a weekly double top. As most of you will know, the double top chart pattern is a bearish reversal chart pattern, and it has broken below the middle pivot, which tells us that the bearish pattern is valid. Now let's take a look at the bullish case for SPY. There are quite a number of them if you know where to look. First of all, the SPY is still in a nice bullish long-term uptrend, and an uptrend is characterized by the stock or ETF making higher highs and higher lows. SPY is still doing it until the recent sell-off. It has not started a bearish downtrend yet, as it has not made lower highs and lower lows. There is a saying, a trend in motion tends to stay in motion, which means that if the uptrend is still intact, the probability of the markets continuing to move higher is higher than the probability of it going lower in the future. Secondly, we are currently at the 50-week moving average, which is the rising blue line. This could act as a support, as the last time that SPY touched the 50-week moving average, it found support and bounced back up to resume the uptrend. The third thing, if you notice, is that SPY formed a weekly bottoming tail. I love weekly bottoming tails, as it tells us that the market is rejecting to go lower. Bottoming tails are usually bullish reversal candle patterns, as what happened during the week is that the market sold off only to recover and close far away from the lows of the week. So this in itself shows that the market is trying to reject going lower. What this means for us is that if SPY trades back above the highs of the bottoming tail, then we are most likely to go higher in the coming weeks. I also like to use the bottoming tail as a gauge of whether selling will happen. You see, if SPY refuses to trade below the lows of the bottoming tail, then we know for sure that the market will most likely be going up in the future. Simple as that. The fourth thing is that the SPY has dropped to an area of support. This is where it dropped to a previous high. If you remember your technical analysis, previous highs in the past can act as a support area. So this previous high is a support area. The previous high back in March, April 2024 acted as a support area when SPY dropped to that area. The last thing I want to bring to your attention is the CBOE Volatility Index, VIX, or also known as the Fear Index. It is quite high at the moment. You can see that it is at the previous high area, which if you notice when the VIX hits that area, the market tends to bounce back up in the past. All right, we have quite a lot of positive things going on in the weekly chart. If you have found the content and analysis helpful so far, do remember to like and subscribe to this channel and also share it with your friends. Thank you very much. Now that we have looked at the weekly chart, let us take a look at the 60-minute chart for the short-term trend analysis. As you can see, the trend of SPY in the 60-minute chart has been down. I like to use the 60-minute 20 MA, which is the red line, and the 50 MA, which is the blue line, for a simple trend analysis. Until recently, SPY has been below the declining 60-minute 20 MA and 50 MA. This was bearish. But if you see the last trading day, SPY has gone back up the 60-minute 20 MA and 50 MA. This could be an early hint of a short-term trend reversal. So what are your thoughts? I'm sure you might have come across other analyses and thoughts like, who would you listen to? What do you think? Well, I'm a believer in doing your own research. It's not a bad idea to listen, watch, and read as much as you can, but in the end, you must make a decision based on your own personality and investing or trading style. But let me just leave you with some food for thought. Remember earlier when I mentioned that historically the S&P 500 has slanted towards positive returns, where I mentioned that it has a 69% chance of being positive in any given year, 79% chance of being positive over a period of 5 years, 88% chance of being positive over a period of 10 years, and 100% positive return over a period of 20 years. Now, what does this all mean? Well, if you're a long-term investor in the S&P 500 and planning to buy and hold for 10 years or more, you could take this opportunity to dollar cost average and buy the S&P 500 at a cheaper price, because it really doesn't matter, because you'll be holding them for the next 10 to 20 years. Just make sure you are buying it with money that you won't be needing to use in the future. Now, on the other hand, if you are an investor or trader in individual stocks, you might want to wait for a bullish reversal chart pattern in your particular stock before plowing in the money. That's because individual stocks can go way down than the general markets. Ask yourself if you can find patterns such as double bottom, bullish reversal head and shoulders, or bottoming tails. Before you enter the stock, you need to ask yourself whether you can find such patterns, as timing is extremely important if you're dealing with individual stocks. So I hope that this video has helped you a lot. Thank you very much for your time. If you find the content beneficial and want to see more content like this, do like and subscribe to my channel, and I will see you in the next one.